Hi, everyone. Happy New Year to you. Welcome to another Learn, Grow, Invest meeting. My name is Jermaine, and this is going to be just another one of those great meetings. Today, I'm going to be meeting with Ryan Strachan, and we're going to be talking about building personal wealth. Now, this is one of those topics that we really are going to cover a lot this year in terms of just wealth building, investing, stewardship, you know, managing finances, etc. Those are the topics that we're looking forward to speaking to the most this year. So this is going to be a great session. If you've seen our other videos with Ryan, he gets straight to the point, gives you great value. And so this is one of those discussions that I'm really excited about. So I'm going to open with a brief word of prayer, and we'll get things going. So Lord, I thank you for this day. Lord, we thank you for this community and that we have the ability to produce wealth with your blessing, with your word, with your guidance. So that as we enter into this discussion, may it be fruitful, may there be value gained by our community. And we just give you all glory, honor, and praise in Jesus' name. Amen. All right, so let's go. Hey, Ryan. I believe you're muted there. Oh,
My t-shirt may recognize what's going on.
Nice. As hoping that you would have worn it. So perfect. This was not planned, guys. Trust me.
I don't know,
All
white
right.
shirt and I go to school.
All right. So Ryan, I mean, just in case there are a few persons here who don't know you, haven't met you before, tell us a little about what you do to give us some context as to what makes you qualified for us to have this conversation.
Well, I thought you guys were just benevolent and inviting, just the regular Joe to be here. But I'm a stockbroker. My daily activities involve read the news. I speak to people. I'm on the phone all day, every day, whether reading stuff, conveying information. I'm really a merchant of information and financial solutions. And I'm VP of Investor Relations at GK Capital. I've been in this business for 12 years. And as you can see, I have Bloomberg on the TV. So it's a non-stop, all day, everyday lifestyle for me. And really and truly, I just approach every day with passion, and it's just a relentless pursuit of improvement. And I have clients under my oversight, some of whom relationships actually go back 12 years. So we would have all grown together, transitioned together, and we're just at the point now where I suppose they haven't gotten tired of me yet. So they just keep me around and keep doing more stuff with me. So I hope that gives good information. I think a transaction people may know about that I would have played a little part in was Spur Spices. Their IPO was, I think, we closed December 31st,
Yeah.
which is probably 9 years after that deal was actually being considered. So it just goes to show that patience is a virtue. And I know you guys are a biblical organization, so you can appreciate that. So that's me.
Yep. Definitely. I mean, so from what I know of Iran and how you speak, and you're always focused on the end result, putting in hard work consistently, and your message has been consistent. And what I take from what I saw of the Spur Tree session was that you laid that foundation, put in the groundwork over those years, and we're seeing the results of work you've done. I mean, many calls and emails and all the work that you've done, we saw just for a brief moment there. So,
Yeah.
I mean, I just think that gives you the perfect, background and history to speak to us on a topic such as wealth, because you help clients build wealth daily. So,
Well, thank you.
um, yeah.
Try my best.
So we're just gonna get right into it. So we're talking about building, personal wealth through investing. So I want to ask you, what's your personal definition of investing?
I view investing as really, it's best illustrated. I've said it many times before, like putting seed in the ground with the expectation. Nobody puts a seed in the ground for the same seed to be in the ground 5 years later. They obviously put the seed in the ground to have a tree and fruit, and hopefully fruit produce, fruit naturally something that can sell or consume, and probably even plant the seeds again and multiply and effectively have more seeds as a result. So I view it similarly. I view it that way in terms of our time. I view it that way also in terms of our resources. And I view it that way in terms of our energy, which naturally equates to our time more often than not. So really, I think investing is a way of producing more than what one started with originally. And I think, however, that many times we may be forced to think of just consumption, okay? And we're not necessarily thinking about how do we actually come out of the whole experience with more than what we started with. And there's that balance required between consumption and investing for the future. But most of mankind is skewed towards consumption solely.
Yeah, I mean, there's a lot to be said for that example, and actually for us, it's exactly the same definition we have. And for those who know our social media pages, if you notice, the logo has a leaf in the grow, and it's because we see investing as a seed that becomes a tree that produces, over and over again. So I mean, definitely aligned with you there. So, in terms of your view of investing, now give us a little bit of a background as to your personal investing journey.
Right. So I can't say to you it was a clear path. I mean, my mother probably, oh my goodness, ages ago, had me and my brother in the backyard, and I think at the time we had this apple seeds or mango seeds. I don't remember, whatever it was. May have been both. And I don't remember the lesson. I mean, we're obviously less than 10 then or thereabouts. And all I remember was that my takeaway from it was that we were putting this thing in the ground and we actually forgot about it. And this may have been, Ivan was 2004, so this is probably a good 10 years before Ivan. And I remember distinctly seeing even the mango tree grow from like that seed into this tree and apple tree, whatever, whatever. I'd love to say to you that made me an investor. It didn't, because if it did, actually would have, planted more stuff in the backyard,
Ah,
throwing it away. But the illustration was there, and I do distinctly remember mommy definitely bringing that point across. Parents, your parents, you can identify. They brought their
yeah.
own the point in their own way, and your son and other kids, God willing, will definitely tell that tale in 20 years, whatever. But all I know is the whole thing of more from less became evident to me from that time. And then for me, it manifested itself in wanting to go into business and to find ways to get the most out of my time. I always thought about how can I further my career or my earnings or my influence as quickly as possible, because I was just not one to do the 40 years of work. Because around that time, I think millennials, those of us just turning 40 would be on that border between
Yeah.
millennials and the generation before us. And effectively, we were like, yo, we don't really want to work 35 years, to get the gold Rolex and the long service awards and all of that. And we were more or less saying, I was more or less thinking, I need to be able to do this in 10. How can I maximize that? And obviously, business became a thing. And then it became a thing of, how can I generate outsized wealth? And then it became a thing of, okay, well, you can actually invest in businesses without starting your own business. And then actually quite like that. No, did I think that I will be putting away whatever amount relative of my net worth in businesses I was not working in? Of course not. But the whole process of starting with the seed and seeing it grow and then realizing you can do more, and then knocking heads with people who knew a bit more and more advanced in the game, following them and then putting more money in and seeing it grow. I mean, eventually I just stumbled upon becoming an investor. And in the middle of that journey, I was actually starting to do it for others. And that was when my career really would have started as an investor, which is a dead end career. You don't become a super investor over time. You're either an advisor or you're not. There's no, yeah, senior advisor by virtue of time, but you can be in something for 10, 15 years and you still haven't advanced to be doing bigger business over that period of time. So life experiences, formal education to the extent that I have a bachelor's degree in finance and accounting, and then eventually getting into the game, as I call it, at 27, eventually had me, I guess, become an investor of sorts for myself and others, or others and myself.
Okay. So let's say that we have somebody who's joining us for the very first time. This is their first investing video that they're watching. How would you describe what investing is? So I know we gave that definition before,
Mhm.
but in a practical sense now, how does it work using businesses or stocks as an example?
Right. So for the first time person, I mean, in times past, I dealt with other people who are in that's actually my preferred client base, persons who may own a wholesale and they may say, listen, I know, they'll say to me, listen, I know about Rainforest Seafoods, I know about Lasco because we buy their products, and not only just buy their products and put them on the shelf, but they sell really quickly. And I said to them, okay, well, perfect. So you will know that iCool just came out, and as you get it, you have to buy more. And then if you're a cigarette retailer, for argument's sake, well, back in the day, as you fill up the dispenser and gone again, or you hear about price increase and people still buy, or you're buying beverages from Lasco or Wisynco, etc., etc. So I said to the person, instead of just buying the stock for your shelves to display and sell, there's also the mechanism through which you can own pieces of the business. Now, incidentally, if you look at the breaking from the explanation for a second, if you look at the top 100 shareholder list of the companies like Lasco, Wisynco that have come to market in the last 15 years, a lot of the owners are first time investors in some cases, and they are usually retailers and or wholesalers, because they now have the opportunity to participate in the ownership of the businesses
Yeah.
that make the products that they sell. So what I explain to people as is, think about it like you are buying or owning some of the products that you actually consume. So
Yeah.
you effectively are paying yourself to consume your own products. And more often than not, that gets the point across.
Yeah. I actually had a similar conversation with my sister just last week because I'm encouraging her to invest, and she's a business owner. She's like, I just don't get investing. So I was like, just think about it as your very own business. And I just kind of walked her through the example. And, I think if you understand business, if you're an entrepreneur, then it's a lot easier to understand investing because you're really just buying a portion of businesses that function and, sell products and services every day. That's all you're doing. So, I mean, the nuances of it, of course, you'll need to learn, but the principle of investing, why you invest, I think it's a lot easier garnered if you just focus on the business aspect and just take it from there.
Absolutely. Absolutely. Something else, however, is that I think many times one of the things in our nature, as I think we've been told, and I think it's not unfair, but it doesn't necessarily have to be a reality, is that we have to work for every dollar that we make. I think investing, particularly stock investing, is runs counter to that and challenges that notion, because stock investing for the most part is passive, in the
Yeah.
sense that people never, short of being involved working for one of the companies they own stock for, people never do anything to earn, past spending money. If you buy Fontana, no, I mean, I don't work for Fontana, but if Fontana pays a dividend, I'll benefit. I mean, I see people walk into Fontana and be very happy and even give them a skip in the line, especially if it's crowded. And I'll happily do that because it just means Fontana will make more money. But the point is, we are making money off these entities without working for them.
Yeah.
But it also means that our resources are being put to use by the companies, well, in the case of an IPO anyway, and that to just enhance their growth and enhance our net worth, etc., over time. So the stock investing does require one to consider work differently. It's almost like you kind of a CEO of a listed business and who owns nothing of it, and one of the administrative clerks who's been there for 25 years was an early investor when the business was founded with small amounts, and the business explodes, and they're 2% at the time. It's dilute, but it's just millions and millions and millions that the CEO can't buy at one time. So effectively, in a roundabout way, the CEO works with the administrative clerk. Now,
Pretty much.
who wouldn't take that, So
Yeah.
that's a
So
bit
so that's actually a very perfect segue into the next question, because we're gonna get right to the meat of the session is, how do you build wealth as an investor? Right? Because that's what everybody wants to know. That's why everybody's here right now. How do you build wealth as an investor?
right. I think you build wealth through. My view is you build wealth through the whole patience involved in the process. So there's two things. One, I think you have to buy stock. Secondly, I think you have to be patient and really, as best as possible, you want to get in as early or opportunistically as possible. Meaning, if you look at Tree's prospectus and you look at I don't think the top 10 list is out yet, but you just look at the conversion of shares. There may have been people who bought into Tree when Tree is valued $50 million at the time, or even 10 million. I mean, you may have people put $500,000 in Tree that will have 12, $15 million post IPO just because they were able to invest in it early enough and benefit from the growth of the brand over 7 years. I mean, one of the things that you hear Mike Leachin speak about a lot now is the whole thing of owning illiquid assets. It doesn't, and I think the mistake people may make in interpreting that is it may not necessarily mean the assets remain illiquid forever, right?
Yeah.
We signed a mandate with Tree. I brought that mandate probably going 3 years ago, And in that time, and remember, this is before COVID, right? And in that time, you'd have had COVID come, all these various circumstances come. That could have spelled a difficult period for them, and we would have been exposed in other ways. The reverse happened. The point I'm making is that the people who were in early at that low valuation, and the circumstances, I think, have to remain private on that side of things, would have been are about to make off like bandits once that thing lists in whatever number of weeks or days, because they were in early and they were able to, and they never required, you see, that's the other thing, it did not require a fortune to make them a fortune, but they were in early, they were opportunistic, and in a sense taking advantage of an opportunity as presented to them, and they held the ownership in a great business, even though it wasn't listed yet. It wasn't apparent to everybody, because nobody's going to be wealthy if everybody sees the opportunity. You're too late by then.
Yeah, you're right. So you make a very important point, and it's one that I noticed, right? Because we actually did a stock review for Tree on this channel, and I saw that same example you gave, somebody who would have had 25 million shares or 50 million shares, that multiplier by 6,036, your 50 million now becomes 300 million.
Yeah.
And that's now valued at $1 per share. But let's say a few months or years from now, or at whatever point, that $1 per share now becomes $5, that 300 million becomes 1.5 billion.
Yeah.
And you would have done nothing but, invested early, held it, and as you said, be opportunistic. And it sounds simple in summary, but you have to go through the ebbs and flows of, waiting, not really rushing to take profit, because somebody could say, well, 6,000 by 50 million is good money, let me take that and run with it, when somebody else may say, well, let me wait for, I'm thinking a longer term, let me wait a little because there is more potential. I mean, to each his own, but
Yeah.
that period could be 5, 10, 15 years. And one could argue, making one good decision can benefit you so much versus trying to do it, by multiple transactions or multiple reps kind of thing. I mean, that's such an interesting way to look at it, I think.
And it's also, it's not a knock on the multiple transaction at all. And I
Yeah.
don't believe you're saying that. I think what it means, however, is having different segments of one's portfolio assigned to different asset classes, then, or for, as we put it in that way. So you have a liquid asset, you may have a unique opportunity to invest in a business early stage, or a couple businesses early stage. One likes the brands and they're going places and they have good management, and you know the people, because chances are, if it's an early stage business, they're not really going to have no whole heap of management, right? It's going to be founder led, etc., etc. Then one may have their big listed companies that they will, buy and forget about, or buy and trade, and they then have some others in the middle, and then they do all the other things, the crypto or real estate and whatever else persons may decide. But the point is, in my view, I don't see anything that's going to outpace the wealth creation of the early stage, relatively liquid opportunity. However, that's not going to pay dividends. You're just going to have to hold that, or be patient with that. No, the whole thing of diversifying means, I don't believe, I know other guys who buy 100 stocks. That's not my style. That may work for others, and they're rich, and I'm very happy for them. My whole thing is to try and identify less than 10, and that I understand I don't have the most time, and I'll just buy and hold and buy more, and then when I hit my threshold, I'll diversify, whatever. Again, I'll buy liquid assets and do my thing there. But I think the wealth creation pattern consistently, you look at every billionaire, they had an illiquid asset that became liquid over time. And it was so it's like, if you're talking about a melting pot or ingredients, you have to put cash in, or equity of some kind, whether it's sweat equity or cash equity, maybe both, sometimes better that way. Some patience and strong management, they can't control that. And time. I mean, we'll say only God makes things grow, but the truth is, a tree is going to need a few years, and you only need one, right? One tree can feed it forever.
Yeah. Exactly. So that's a dynamic, right? Because definitely a case for diversification, but we agree as well, and that's what we say to new investors: 10 or less, so it's easier to track, easier to manage as you learn. I see persons asking though, how do you get that opportunity? So you mentioned getting in even before the IPO. How do you find those opportunities? Or what are some of the ways that the average person could maybe get access to those?
So everybody has friends, right? So what I would do, I would look for my enterprising friends. And if I trust them and I trust their instincts, and they said to me, listen, I have this opportunity, I'm trying to raise a couple dollars for my business to take advantage of this opportunity, and they come to me, I identify the kind of risk I can take in terms of size, and then I would just say, okay, well, here's $100,000. or if it's $1 million, if the risk, the opportunity warrants it. And they may say this translates to 10% of the business, and we get our shareholders their certificates or agreement or whatever. And that's it. I think the average person won't be able to get access to every opportunity because the opportunities tend to be unique to the friend group. So when Mark Zuckerberg was starting Facebook, it was his roommates and maybe Eduardo who had the opportunity to buy in, and they're all filthy rich as a result, right? I mean, the roommates even got to buy in; they just dropped out of school with him, you know. And they all want to meet. Well, Eduardo made some money one summer and bankroll them. You know, Eduardo is $2 or $3 billion plus now, just from that.
Yeah. From that one decision, right?
One decision. He's never worked a day in Facebook. You know, and now I'm taking money and he just, fly up and down the place and live in Singapore and put money in, he's a venture capitalist now. So the point is we all have our unique windows. I mean, somebody may say they like your business, one of your friends, or you may go to your friends saying doing a fundraise to pursue some expansion opportunities for your business, and they have the opportunity to buy in. They will still work. Well, they may say, all right, Jeremy, all that 250,000 or whatever, and you get your funds to go do your thing. Your friends in. I mean, if you're open up, I think you have a wide enough base to look at. But that's how it's done. It's not rocket science. I mean, I never got a chance to buy into Spreadsheet. Maybe it's for the best thing in the end because I wouldn't have been able to do the other side of things. But point is, we're going to have benefited in other ways from other opportunities. But it's just a matter of, to me, I would say it's just a matter of keeping one's eyes open to opportunities around them. I can't tell you when somebody's going to knock at the door, but the person will win or lose the person who answers the door.
Yeah. And that's the thing, right? So I'm glad you said it near the end there. I want persons to understand that there's not only one opportunity. I mean, there's only one Facebook, maybe, but there are similar types of opportunities that are there. It's just that it takes vision for the person seeing. Imagine those persons who would have had to invest in Facebook at the very, very early stage. They don't even have 1 million users yet. They don't have anything that you can look and see that, yes, this is going to be something great. Somebody has to see or at least agree with the vision of the founder and see where they can go. You have to see the potential of where the company can go and not necessarily where they are right now. So there's something to be said for that as well.
And I'll add that, in like the Facebook case, none of them saw it going as far as it did, and that's a fact. They just saw it as a means to, and if you read the early things, they just wanted to meet girls, and they found it as a way to connect everybody at the school at Harvard, and it just caught on so quickly that it became a thing of, okay, well, they extended it to Ivy League, and then they extended it to, I think it was to that cluster, and then it became Ivy League, and then colleges in the US, and then, it just kind of like, that's how growth comes. You can't predict it. I mean, I don't think Nike is another story. Nobody knew Nike would be where it is today, but what they started with the vision of they wanted to make the best running shoe ever.
Yeah.
And then issues and lawsuits and whatever, and then it became a thing of just they're going to basketball and whatever, and Michael Jordan, and they had got pay for him, and just a bag of different things that have made it what it is. They almost collapsed in the 80s because Reebok, I think you maybe remember when Reebok was really firing aerobic shoes and all that in the 80s and 90s. And Nike was falling behind. So the point I'm making is, but the people who were in it early. So when Nike IPO'd, everybody was rich. I mean, Phil Knight was in debt till his 40s. Then the IPOs, and he never worries about money again for another day. Yeah. After struggling for 20 plus years. So as the people, wealth building is great. It's not sexy, but it takes some guts, and it just takes holding on to something, and sometimes knowing when to let go. But you don't want to be one of the people who Zuckerberg came to, and they had no money to put in it. By the way, they just had sweat equity to put in it. To be very clear, and who Zuckerberg came to, and they said, it's all right, we'll pass." Can you imagine that?
Oh my gosh. Yeah. I
It's like
mean,
five of them passed.
yeah, and the interesting thing is that I'll share here is that one of the things that we do, my wife and I, is that we think in investing in companies outside of the stock market as well. And we've actually approached a few companies, be like, we like your business model. We think this is a great opportunity. Would you be open to investing? And a lot of times we see where you recognize somebody has a really great product, great potential, but sometimes the founders themselves don't see it. And sometimes we walk away from that opportunity because we're like, they don't know what they have. They don't know that with the right catalyst, the right marketing, the right management, that product can just take off. And I mean, that's one side as well. I'll share with persons here, because that's what we actively look for, opportunities that we can invest in ourselves. Because some businesses don't necessarily need a lot of money to take off. It just needs maybe the right manager, maybe the right developer, maybe a key person, and the right environment. A lot of businesses made a lot of money during the pandemic, and it's just that the conditions of the environment provided everything that it needed to grow. So I mean, that's also something I wanted to share with the audience here, that you don't have to. I mean, the stock market is definitely one of the channels that we advocate for to build wealth, but the stock market is a reflection of the business's success as well. So if you have the opportunity to start a business, own a business, have a portion of a business, that's a great avenue for wealth creation as well.
Absolutely,
Yeah.
absolutely. In fact, I would want to say the stock market sometimes is where one realizes it's almost like it's the it creates it. Obviously, it's making your one's equities liquid, right? So
Yeah.
person can say, "Oh, they have a liquid net worth of X dollars or whatever." It's very useful, of course. That brings with it its own stresses, but there's many wealthy people who never, invest in stock market in their life, but
Yeah.
chances are it's going to involve some leverage and equity of some kind. It may just be private more so than public, but that's getting complicated. So,
Yeah. 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 All right. So one of the questions that we see a lot are persons who want to invest and they're not really sure how to manage their finances or generate enough cash to invest.
mm,
How do you treat with that situation for somebody who is not, it usually shows up as a question of how much do I invest?
mhm,
How much do I put each month? When do I buy? Those kind of questions that I'm sure you've probably heard a couple of times.
yeah.
How do you advise persons for that scenario?
Well, I think, yeah, as I say, they have to have something, right? So, short of borrowing or stealing, I mean, we really have to be working or, inheriting something to then have in hand. You have to have a seed in hand to effectively be able to put it in the ground, to put them in the ground. So, in that sense, I mean, that's relatively straightforward, in terms of the means to generate the capital to invest. I think more than that, though, is I think investing is a mindset thing. Sorry, and a lot of times people think that, again, this is counter to, and I mean, it can be counter to human nature, or it can be counter to the excuse that I have to have millions to make millions. And still come back to the spur tree story, where effectively you had people who participated in it in a quasi private equity setup for a stake in the business, which is this is my interpretation of it, to be clear. That, as and I mean, it's in the prospectus, you would have seen the stock split, and the outcome as a result of it. Not, I'm sure not everybody started with millions. And I'm sure if you go back and if you ever get to interview the spiritual guys there and you ask them, they may say to you, oh, we never started with millions, we bootstrapped, you know?
Yeah.
So I think obviously, you know, working, if you inherit money or whatever, that's how it starts. I don't have many scenarios anymore with early stage investors, I will admit. I mean, maybe in an audience such as yours or more, you know, a larger type presentation. But yeah, if it's a youngster, say, well, it's, you know, time to get a job, you know, or make mommy a money or daddy a money. But, you know, that's the only way I know.
Uh, I mean, what I typically, well, let me just share what we did because that can probably help some persons as well.
Sure.
When we started to see the value of investing, my wife and I decided to just cut all unnecessary expense, and
Mhm.
every spare cash we had went into the market. So at one point we were investing, a nice portion of our salary straight to the market. And I mean, over time we had to do less and less because we've made other investments,
Mhm.
but we prioritized investing. Essentially, is what I'm saying. So the amount is not the important thing. We prioritized it. We did it consistently, and in only a few years, we're seeing just a great appreciation of what that same seed that we would have sown a few years back. So I mean, just kind of adding to the point that you made, that you just need to have something invested. You need to plant the seed for the tree to grow. So I just wanted to share that as well.
And
Um,
I affirm that.
yeah,
I affirm that. By the way, it was similar. It was similar. It was similar for me. I mean, when it was I alone. I mean, I started with just the surplus or whatever 10% or whatever I made, whatever that looked like. Sometimes more, sometimes less, sometimes nothing at all.
yeah,
And then maybe about 7 years ago, it really became material in terms of what no, 7 years ago, it became material relative to what we had, and as that grew, portfolio would have grown. It became a bit more significant to the point where, you know, if we do invest now, it's the number one expense in our budget. We budget. So that's kind of where it is now. So that's a priority for us, similar to what you would have expressed. You
yeah.
and your
And and what persons don't realize is that over time, there are certain expenses that once you get to a certain stage, I mean, food is probably the only expense that we can agree just always goes up. For most of the other expenses, if you're paying a mortgage, that is typically a flat rate that's not going to move. Over time, your income will typically outpace your expenses once you can keep your expenses manageable. So you will have the opportunity to invest more and consistently over time. But there's this sort of, we see sometimes this kind of need where, I need to make a lot, I need to get wealthy in 6 months kind of mindset. And persons just really not appreciating the fact that, if where you are now, where we are now, we can talk the way we speak. We're speaking because we have laid a foundation a few years back. So I mean, that's kind of what I want persons to understand. It's not get rich quick. I mean, not saying you can't, choose the right thing and maybe make a few 100%, but we're not talking even about getting rich. We're talking about wealth, and wealth, as Ryan says, takes patience. It takes opportunity, and you have to give that tree time to grow. All right.
Definitely. And the
Um,
illustration, just I guess just to tag on briefly, the illustration is like, Peter Thiel bought 10% of Facebook for $500,000 17 years ago, right?
wow.
In 10 years, had he held everything, which obviously he could not have, given how much it had grown to, that 10%, that 500,000 By time the IPO had become more than $1 billion. This is US.
Yeah.
And this was even after he had sold a lot over time. So of course he took the risk early. Well, Peter Thiel, part of the PayPal mafia or whatever. Sure, I mean he could have done a lot of other things with the 500 grand, but he decided to, among other venture investments, to put funds into Facebook when the founder was like 23 or 22, coming to his meeting in slippers and a
Yeah.
hooded sweater and thing. So the whole point is it's only a mindset that would make somebody do that, because I'm sure they went to other people and they were like, "Yo, you're crazy, come up my office. When you come into my office dressed like that, you don't know how we dress."
Yeah.
As Gen
Yeah.
Xers. So the point, that's why I say it's not just a money thing, it's a mindset thing. I've met countless people who will never buy stock in their life because they are just not comfortable with the idea of putting money into something that they can't control. They're
Yeah.
just not there at all, you know?
I know quite a few persons in that way as well. I speak to persons about investing. I advocate for investing with everybody who knows me. There are some who just they understand certain things and they're like, I know that. I don't understand how you make money in the stock market, but I mean, yeah, we'll get back to that a little later. All right, there's a different perspective, and you mentioned Michael Leachin earlier, who advocates for the use of debt in investing.
Yeah.
So for the person who may come and say, well, I have some debts, I have these loans that I'm trying to clear. Should I clear these debts first, then I invest? Should I invest now and hopefully the proceeds can help me clear the debts? How do you normally consider debt and investing? What's your take on that?
I think it comes down to what kind of debt. Okay. So if it's debt that came as a result of, and I don't mean irresponsible decisions in the typical sense, but if it's a mortgage, then a mortgage is not necessarily debt in my mind to the extent that people may say, because it's tied to an asset, right? But if you're gonna run up massive bills to buy clothes to wear at a party that you don't want to repeat because you're afraid that one of the companies, the photography guy, is going taking the same outfit twice, then are you getting the best bang for your buck, short of
Yeah,
it being you being a socialite and you're paid for photographs, or you're paid from Instagram posts and the brand or whatever. So I said that to say it depends on what kind of debt it is, because you want to minimize empty debt. And what I mean by that is you want to minimize the extent to which you take on debt for assets you can't sell in case you're in a bind, or assets that are not earning you anything. Which is why I said to people, a lot of people may talk about car loans being bad or whatever, whatever. But I said to them, if the car is making you money and one day the car is going to cost you money, then that's a problem. If you have a car
yeah,
loan to drive from here to the office or the country for a weekend, then I would agree with it. So everything is a whole lot due down to context. I said that to say, if you're speaking about clearing debt before investing, I would say your investments really should be a line item in your budget, similar to what debt payments are. So I would say to people, and I said to people as well, to carefully manage their lump sums. So a man told me, years are like rolling really quickly. It must have been 8 years ago, I think, saying to me, you need to me, he said to me, Ryan, you need to manage. Cause I'm not the best saver, so he said to me, you need to manage how you accumulate funds and what you use the funds you accumulate to do. And I said to him, okay, fine. So then he said, all right, you may want to buy a house today, and the house you may want to buy today, you save up whatever number of dollars to buy it. He says in 5 years you may not want it. Now, real estate minded persons may say, yeah, well, you can sell it, whatever, whatever, and there's another argument to be had on that side, right? But he said to me, "Is the house you want to keep? Chances are in 5 years you may think you may outgrow it, whatever, whatever." So he said to me, "What you do? Try and grow that lump sum so that you're in the category to buy into the house you want to keep for a longer time. Should you decide to go down that road?" I
Yeah.
take it the same way in terms of how persons approach debt, and I mean pre-investing debt. So one may say, "Oh, you have a debt of 800,000. You save up 800 grand, you can take it all and pay off the debt, right?" Someone may say, "Pay down half, put 400 into investments, and then see what happens because you'd still be working. So the same diligence you use to pay off half of it, you can obviously use that diligence again to pay off the other half."
Yeah.
What happens a lot of times is people clear their debt, right? They don't have anything else to show for it, and then what happens in 5 years? They build up more debt, right? So they spend the whole lifetime paying off debt. And I say to people, treat debt as part of your portfolio. So, best example, Panjam borrowed. Forgive me if you guys are watching. I don't remember the exact number, but let's say Panjam borrowed $2 billion. It's close to this. I think it's 3 billion, but they borrowed $2 billion or 3 billion to buy 8% of Sagicor at $7 a share, right? Now, people need to understand it's a private equity firm. Panjam has debt as part of their business model. They may not be more than 15 to 20% debt to equity, but that's part of their model.
Yeah.
They borrowed to buy Sagicor at 8 or 9, right? Sagicor today, 8 years later, is 54. They're still servicing, they may still be servicing debt or whatever, but that 3 billion they borrowed is now like 40 billion. If my
Yeah.
math
Yeah.
is correct, not 40, like 8 6 like 18 billion.
36, 6 times. Yeah. Yeah.
18, right? So the point I'm making is, that's not empty debt at all, because I mean 8% of Sagicor has grown over that time. And I think that premise applies as well to the casual investor. So now Warren Buffett says, don't use leverage because you don't want to risk being wiped out.
Yeah.
Again, that's fair. However, margin accounts now in Jamaica, not the US now, where you can borrow multiples of your portfolio. Margin in Jamaica is you can borrow up to 40% of your portfolio before you get a margin call. So Jamaica debt-wise is very conservative on the
Yeah.
risk
Yeah.
standpoint. So people need to understand the nuance of what Buffett was saying. It's not like you're borrowing, you have 1 million in a broker and you're borrowing three. Then you can get wiped out, of course. It's not that at all. And remember, the interest rates there are much lower. In our
Yeah.
case, so it wouldn't apply to us. So I say all that to say it's important to classify debt as part of one's portfolio to the extent that it doesn't pass a certain percentage. So I would say where paying it off is admirable. What's more important is what does one do with the cash they have.
Yeah.
You want to keep your debt manageable, but I don't say to eliminate it because something may happen. You incur more, and then they'll say, "Oh, I'm tired of this. I give up."
Yeah, I mean, so that's trick with debt, right? A lot of things in terms of our perspective of debt is what we've learned, and sometimes a fear of debt can impact your willingness to even comfortably service a debt and invest. Where I mean, the peace of mind is priceless, definitely, but there are certain levels that I imagine if, for example, you want to invest in a startup or you want to take certain opportunities, you may not have the capital, but because of your base, you have the potential to get multiples of what you already own. Without being comfortable with that, you may not be able to take advantage of those opportunities. So I agree with you. I think the part that I normally say to persons is that it depends on where your debt is. So if
Mm.
if it is that persons are going to come to your house tomorrow to repossess something if you don't pay it, then you want to prioritize the debt in that case.
Sure.
But if you can comfortably pay it down because maybe most of the interest is already gone and there's no incentive to pay it off early, then there's no rush. You need to just shift your mindset and say, well, if I pay this off in 3 years, $10,000 a month, it's done.
Yeah.
But then now, if I invest another $10,000, maybe I can, see something build in terms of my portfolio over 3 years, as opposed to waiting 3 years to start investing, because that, I think, it's a great opportunity lost in that way. So I agree with you. It depends on really the context. With everything with personal finance is
Absolutely.
context.
Absolutely.
But a
And
lot
you
of
know,
persons fine will
oh,
ask that.
you go on.
No, I was going to say a lot of persons ask that question around debt, or they'll ask us, should I clear my debt first, etc. So I really wanted to get your take on that. So
And it's nuanced as well, because the thing is as well, I think persons have their debt repayment being higher than what they would invest. And I think that's also, again, a whole matter of
yeah,
priority. So you check it, people, you may have in some cases the bill from courts, not courts as in the retailer, not the court, eh? But they may say, oh well, they have to pay courts 40 grand a month, and then you say, oh, you need to be buying, you know, Grace Kennedy stock. Chances are what they bought from courts, they're going to have to replace by the time the debt is paid off.
yeah,
And Grace Kennedy may grow multiples in the time frame that they are paying off their asset at court. So again, it comes down to priority. I don't think something replaceable like a fridge or a stove or whatever. I would say you have to manage your expenses on items that are easily perishable in favor of the items that can actually bring you closer to your goal in
yeah,
5 years or 10 years or even 3 years, because we get into patterns. Again, it comes back to consumption. Now, I will never, I am a consumer, so I'm not going to tell people to not consume. I'm saying to people, however, put first things first.
yeah.
You can't have a cell phone that's worth more than your portfolio. I think that's a universal rule. That's just not
That's a
practical.
good benchmark. That's a good
You
benchmark.
can't,
I like
for
that. I like
starters,
that.
if you have more in your portfolio, then in terms of what you've put into your portfolio, then you need to reassess your priorities. If it costs more to service your car than what you have in your portfolio, again, that's the kind of thing that you want to be working to get ahead of as quickly as possible.
Yeah, yeah,
Because then
yeah,
the only one chances are, I mean, of course, if you're an insurance person or in my line of business, then your vehicle is very important for mobility and reliability, whatever, whatever. But priorities, it can't be that, there's some little benchmarks that we use in financial planning, which you can get into at another time, that guide the amounts that one should have invested versus what they spend. But it's first things first. You don't want to be at the bar spending 30 grand a week or 30 grand a month when you don't even have $1 million in the market. That's just gonna keep you in financial poverty forever. Yeah, and
yeah, yeah.
make sure you have to work forever. So those are the things that I think we need to assess. I mean, maybe for the persons who drink, you have to just lay off the 12-year-old rum and buy white rum until they get a portfolio of consequence, and then you do what you want. But
I
you
mean,
have to,
you're making a very important point here that I want to be sure persons get. So there is no one thing that is being bashed here in terms of how you spend.
yeah,
What Ryan is saying is the balance now between your investing portfolio and the other stuff. So for each person, it's different, and we all spend on different things based on our priorities. But are you serious about investing and building wealth, or are you trying to maintain a certain lifestyle that may not be conducive to you building that wealth? Because I mean, we spend money on what we value. So if we value a certain thing and we're spending accordingly, that's fine. But if you're pursuing the goal of building wealth, it requires at least a short-term, medium-term sacrifice, because once you've built up a certain capital, I can say firsthand that the opportunities to invest become a little bit simpler, where, you know, if you're starting out with 50, but maybe now you have 500, you can say, well, I may not, I may be able to invest now 300 on this opportunity and maybe spend, you know, 50,000 on a nice vacation, as opposed to if I have 50, spending it all on the vacation wouldn't make sense because of where I am. And that's what Ryan is saying. So if you're not at a certain point, don't be thinking about things that are not as impactful to where you're trying to get to. Once you get there, you'll have more opportunities. Money creates opportunities to do things sometimes in a simpler way, just because you have a little bit of money. And you'll see it especially with the financial institutions. Once your account gets to a certain point, you may get a call from a bank person that you never got before, an email, simply because your account balance is different. That's kind of how these things work. I was saying to someone yesterday that there are services and products that are created to take money from wealthy people. So once somebody has money, there'll be somebody somewhere reaching out to you to get you to spend that money. So certain things you don't even have to run down, because they'll come to you once you have the capital. I mean, I don't know if you agree with that statement.
No, I think that's. I mean, I'm getting accredited investor emails now, and I'm just like, this is.
Yeah.
I think they're the wrong person on the list, you know, because it's, and I mean, I'm telling you, like when I started, I'm not saying, I mean, not every deposit was 10 grand, but I distinctly remember there's a time, you know, me and the missus 10,000. I mean, we just had some different things dealing with at the time. And, you know, 10 grand, I mean, look, a hustle here and there, 50,000. And, you know, you buy Berger at 3 and you sell at 20 in a year and a half, 2 years. And you just see this thing mushroom, you know. So, but the point is that I wasn't drinking Hennessy then out of my pocket, because it just did not fall in line with everything. Nobody is saying you're going to live in austerity forever.
That's the thing. Yeah.
You're never going to, it's not going to be a forever thing. It may be for a year or 2 years, and then you may realize your dividend checks are, you know, more than a bar bill. Then you're like, all right, okay, cool. Then you have a little bit more latitude. Sure, at that point, you have different distractions you have to deal with.
Yeah.
But you have to, the building phase is the boring phase, you know. I mean, when you're digging a foundation, I live beside a construction site. I mean, so I get to sit behind the zinc fence and I see the big hole at the back of the place, and now I see all the blocks being laid, but the general public not going to see it until they move the fence, right?
Yeah.
But the whole point is that in the midst of that, work is going on. And when you're building a portfolio, your mind and getting used to prioritizing and putting away, yeah, it's boring, but this is not somebody's seen you for 25 years. In fact, what we're actually saying is we are trying to shorten the 25-year period that the average person would want to wait to really live life. You want to take your family to Italy or Australia. You don't want to wait till you can barely walk to do it, you know. So all I'm saying is that it's just about having a plan to get to where one wants to get to. And I think your point is very valid in that respect as well.
Yeah. All right. So we're at the hour mark. I want to thank everyone for being here. We're actually going to be splitting this video. So I'm actually just doing this to welcome everybody who's been here. Keep posting those questions for Ryan. We're going to get to them shortly. Please take a moment to like the video. It helps us a lot. When you like the video, it tells YouTube that you value the content, and then it will show it to more persons. And let's actually take one of the questions that we see here. I always see this question when Ryan is here. A. Wilson is asking, how much does he need to have for you to be his investment manager?
Who?
Someone called A. Wilson is asking, how much money does he need to have for you to be his investment manager?
That's the first person to ask that? Today.
The first person today, but I think we see it every time that you're here. At least
All right.
that question once.
He's the first person to ask. You can give him a number. We'll set up something.
All right, perfect,
All right.
All right. Oh, she. It's a she. Okay.
See? All right. Cool, cool.
Perfect.
No
All
problem.
right. I think this person. I'm sorry, I don't know how to pronounce that. They're asking, what is your plan for retirement?
You mean for me in terms of, I mean, what, work or wealth, or I don't understand. That's a broad
I'm not
question.
sure. Can you give us some more context? The person who asked that question.
And let's catch up on a couple messages. That's all.
Yeah. Somebody wants to know what are your top stock picks. Let's actually take that one at the end, please. I think that would be best. Miss Mads is asking, would you recommend trying to buy your own stocks or investing in a managed portfolio?
Depends what your outcome is. If you want to be wealthy, then you have to buy your own stocks. If you want to tread water, so to relatively speaking, managed portfolio. So, I mean, the truth is both have unique risk. In a managed portfolio, you're obviously paying more fees, and that's great for the broker because they'll pool your money. And I mean, you can imagine you may grow, you may not get dividends, depends on how the fund moves. But I mean, there were funds that had red stripe in it at $4 for years, and then red stripe from 4 to 32 in 18 months. The funds
Yeah.
probably grew 90% at the time. Looks wonderful. The shareholder in red stripe made 700%. So it really comes down to what one wants. It's going to rise slower, the funds, than the actual stock itself, and it's going to fall slower than the stock itself usually. So it really comes down to one's overall objective.
Yeah. Yep. All right. So the person has reframed it and saying, what are you investing in for your retirement? I guess what's your retirement strategy?
Me?
Yeah.
No, I just buy stock. I mean, I have a pension. I contribute. I've recently started to contribute the maximum, primarily because I'm spending too much money, but that's another story. But,
Yeah. I know
I
what you mean.
yeah, I just got a little reckless. But so I contribute the maximum, so at least I assure myself. I actually looked at a number the other day, and it was it's something else, but that's another story. But for my retirement, I am banking on my illiquid and liquid investments for my retirement in 25 years. I believe that what I have invested and will invest in the immediate future, in 25 years will be more than enough to retire. Not that I have a plan to retire because I love what I do. So, I think naturally my future is going to involve a business of some kind in my, well, I mean, which in finance, because at the end of the day, I still have some independence where all that's concerned. Without getting too specific,
Yeah.
but I am for my future. I'm a stock investor, and that's for me. I'm not going to say to people, don't buy real estate, don't buy this, don't buy that. But for me, my temperament, I am a stock investor through and through, and I will buy into anything that I think has potential. And once I see a growth angle, I'll go into it hook, line, and sinker.
Yeah. Yeah. And I mean, for those who don't understand the concept of a pension, we have a video here that was done with Roxanne Wizard from my my accountable dollar a few months back. Check out that video. We went through the full process of understanding a pension, learning how to do the calculations, etc. All right, so let's get back to. We just have a couple more questions that we'll ask you, Ryan, and then we'll be able to go into the full Q&A.
Sure.
So in terms of so we just finished speaking about debt, and we spoke a little about cash management, prioritizing what you spend on, etc. In terms of what you see, just from your experience in working with different types of investors, which investment strategy is underrated and which one is overrated?
It's a good question. I think the the passive investor style is overrated. I think people too quickly think that they need to take their eye off the wheel because they don't understand what's going on. I think many times it's best when people have an idea, or I would say not all advisors are created equally. So one needs to be uber careful about who they give their resources to
Yeah.
and turn a blind eye to in turn. So I think the passive investment style is over. And passive not in terms of passive earnings. I mean passive in terms of just not paying attention to what's going on at all. I think yes, it's benefited people greatly in many cases, but I think it's also caused some measure of capital losses in some
Yeah.
cases. And I think that is what has led to people malfeasance in the space. And I think it's led to laziness by some advisors in the space. And I mean, it's not, and this is globally, I mean, not just locally. I think generally speaking, you should be able to ask your advisor, why did we buy this? Why did we buy that? And it should have a reason, because at the end of the day, that's their job. My
Yeah.
clients, ask me every so often, and I'm able to provide an answer. Because at the end of the day, I mean, they don't always want to know because it's not their concern, but fine. What's underrated, however, by the same token, funny enough, and again, nuance is the whole thing of buying and holding. And I say that because one may think that, oh, well, if I'm passive, then if I'm not passive, then I need to be trading every month. I mean, in some cases, I mean, yes, I mean, if that's necessary. But once your portfolio grows, especially if you're talking local equities, you can't trade every month because you don't have your pool of buyers is shrinking as your portfolio grows. You
Hmm.
can't trade $100 million of Jamaican securities a month as one person. It just doesn't happen. So that's when your real investment chops are tested because you now need to account. And if you do that, somebody's going to say, well, he just bought this. Why are you selling? You know, no,
Exactly. It's more noticeable the larger volume buying
absolutely.
and selling. You can't sneak anything under the radar.
Absolutely. So you can do your thing in a million or five. I mean, when you start past five in any one security, you're going to have to work to trade that. If it's 50 grand, all right, fine. You can move that tomorrow. Jamaica, no, right?
Yeah. Yeah.
Because Jamaica may not have the volatility that you have in the US market. No,
Yeah.
there have been some Jamaican stock that have just crumbled and that I always thought was going to, like JetCon and others, for whatever reason, right? I mean, there's no stock, not every stock is going to go up indefinitely. But
Yeah.
I think the whole thing of thinking that one has to trade consistently is probably flawed. And as I said, that theory is proven the larger portfolios get. However, many times I think we can also sell too early. Well, not however, but more in addition, we can sell too early. You know, I remember when I was at another brokerage house, or my first brokerage house, we did Lasco for a guy, and he said to me, I've never made money in the stock market before, but he was a retailer and bought Lasco for him. I mean, that time I got the IPO document, the application, parking lot, 8 o'clock at night, right? I think the night before it closed, whatever. He sold Lasco at the time at $4. Now, if I remember, 10-to-1 split, so he bought at 25 cents, he sold at $4, and he said, boy, I made 150,000 on my million. First time I'm making money in the stock market. He made money. His retail establishment is humongous now, so he's not suffering. However, Lasco manufacturing is now $4.70 10 years later from 25 cents, 470. That's 2,000%. 10 years. I mean, one may say, yeah, you made money, your business is massive, but that million will be 20 million now. You see where I'm going
Yeah,
with it in
yeah,
relation to all the
yeah,
dividends over the years. So I think sometimes the whole thing of buying and holding, if the business is going in the direction that's appropriate, can cause one to sell themselves short.
yeah. So there's this idea, the way that I think about it is that, and I watched the interview between I can't remember the name right now, but I'll post it in the description, where Michael Leaching was talking about, he was showing the compound curve, and there's a point at which you don't need to do the same amount of work to get returns just at an exponential rate. And that's how I see investing. So there are some companies that, for me, because of the nature of the business, if I understand it well enough, I'm saying, well, sure, they may not even be moving much right now, but you will see just these massive jumps, 50%, 100%, 200%. And, then it may just be still for a little while, not doing much, 10% here, 5% there. And then it jumps another 100, 200%. And the average investor can't time that. The average investor may not have the opportunity to even research or manage or track that. So it's just for you to understand that what I say is, if you don't need the money, if you don't have anything else to do with the money, you're better off staying invested, if even for dividends or for the opportunity that you can continue to grow that wealth. Now, if you have something to do with it, sure, but if you don't, you're better off staying invested, in my opinion. Yes, it's Mark, Crosscarry, and Leachin. Yes, thanks, GK. So I mean, it's have this stock for me, it's Microsoft, Ryan, that I bought it while I was working at Microsoft.
Mm-hmm.
And so I started buying it when it was around $58, and they gave us the opportunity to buy on through the employee stock purchase program. So we're getting it at a discount. And I was buying, and just kind of watching what people have to say about it. I didn't know much about investing at the time. And some persons were like, the stock is going to peak out at 120, 140, take your profits there. And I
Yeah.
put it to the Learn Grow group, and persons were like, if there's nothing wrong with the company, if you understand the business model, if you don't have a good reason to sell, because I remember the day when it was 140, and we've been waiting for it to get there for a long time. And I was like, guys, I've made more money than I was planning to make from this. It looks good. Should I just take some profit? No. And everybody was like, Jermaine, calm down. That was 2018, I think, or early 2019.
Mm-hmm.
Now it's at $300.
There you
So
go.
I mean, it's just, I didn't have a good enough opportunity to liquidate it and say it would do better than giving me US dollar appreciation, dividends that are reinvested, and a business that I understand thoroughly, because I worked there. I know the company, and I know their best quarters. I know the product roadmap. All of those things I know.
Yes.
So, I mean, I use that example often because in 4 years, maybe 5 years, or a little bit more, there's work, there's a compounding to that initial amount invested, that if I tried my best to do that, otherwise it either would have taken me more time, which means I'm not as productive at work, I'm not as balanced in my relationships. I maybe couldn't have spent time building the Learn, Grow, Invest community because I'm there actively investing. So
Right.
there's this balance that you need for life and living, that sometimes, as you said, just buy and hold could be simpler than trying to do something that maybe the average person is not that great at. But I think sometimes we get caught up in the stories of others, when we see others project, hey, I did 300% here, I did 500% here. Some persons want to aspire to that, and
Mm.
so they may trade more than they need to try and accomplish what somebody else has done.
I mean, yes, I think you're dead on, right? Um, Again, context, for
Yeah,
every earnings season in the USA, so everybody should. I mean, a lot of people would know. I'm helping the US market on behalf of others. You have after hours trading. You have after hours trading both when the market closes and before it opens, and
yeah,
at around so 2 o'clock Europe open. No, 2 o'clock Europe opens. China would open about around now, and blah 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 blah. The point I'm making is you still have activity happening when the market's closed, and that's
yeah,
because you have options traders, you have guys with the arbitrage guys in other jurisdictions. That's what makes a market, right?
yeah,
Right. So they have to make money in the short term. Some are short, some are long, blah 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 blah. Just like forex, the legitimate forex. The point, however, is that if somebody is a buy and a holder, so to speak, or in it for the long haul, and they're trying to mimic the options guys, then they're gonna face devastation or they'll be very stressed out, right? Which now reinforces the importance of everybody knowing where they fall in the community and
yeah,
acting accordingly. So I'm like you, and this is the people, especially when the portfolio start to grow to a certain size. You're gonna come to the point where your portfolio is more than you can save in a year, 2 or
yeah,
even 3 years. And you have to sit down with what you have. You see what I'm
yeah,
saying?
yeah,
You at that point, you become an investor. I mean, you can speculate and whatever and get to that point, but you're gonna come to the point where I mean, you have people who are buying CPG at three. People at CPG at $1 million in CPG at three. They have 5 million now. So if they get it
yeah,
sold, they're not gonna have to be like, boy, 5 million, I could pay down on 2 houses with 5 million.
yep,
I can clear out my bills. I could pay down on a reasonable car with one and borrow the rest because I have to be able to service a debt car 5 million. So they have to face real life choices at that point. No, there are persons who want trading activity because they make money off advice. There's nothing
yeah,
wrong with that either. But where does everybody fit in the overall spectrum?
yeah,
And understanding that will then inform person's actions. So we are in the trading business in the USA to an extent. There are stocks that we trade regularly. We've been trading Netflix for a long time. We buy at 200, sell at 500, buy back at 350 and whatever, sell them because it's volatile. So you have to know, and that's driven by the beta. And I'm sure you guys will talk about that in your community as the beta,
yeah,
the extent to which it mirrors the overall market, and now it's a very volatile time. So some of us, will make money on a Netflix's volatility and others, right? But there are other stocks like a Berkshire Hathaway, for argument's sake, that we never sell. That we just don't sell it because there's really no reason to.
yeah,
It's only
yeah,
going one way up. I mean, even Blackstone, like we may trade Blackstone, but we always buy Blackstone on weakness, like always, because
yeah,
it's just that kind of company that does not lend itself to precipitous falls, and if it falls, it's really and truly an irrational movement in the market. So I say all that to say that there's many guys in the market who need to make money. And then we have the rise of what's the name of them guys with the GameStop? Is it the meme stocks and the Reddit community and in Wall
hmm
Street?
Wall
Wall
Street
Street.
bets and those guys, yeah,
Exactly. So they're all competing for their little space in the overall marketplace. So that has to be
yeah,
considered as well when we're viewing portfolio decisions because one can be easily misled, and that's why focus is so important.
yeah, I agree. So, I mean, definitely just agreeing with you again because so there's this it's something I say in our in our Telegram group a lot, where if it's your first time, please join us on Telegram. We talk investing daily there. I'll say to persons that I do a few trades per year, and I got to that place now because what for us and our investing style, we are relying on multiple avenues of investing to get where we're going. So I know that if I sacrificed some of those opportunities and maybe focus on the stock market only, I would do better there. But I'm also thinking long term, and I'm thinking you always have to invest, I think, with the understanding or the appreciation that your income may not always be what it is now, your health may not always be what it is now. And so you have to kind of invest and say, well, if the market is not as favorable, if I don't have the same capital, if I don't have these things, where would I want to be? And so for us, we invest such that as soon as we have the amount from in terms of capital to invest in like a real estate property or something, we're doing it because that for us is something that is a long-term strategy that we need to live now. We need to enjoy our gains now.
Right.
But seeing into the future, if we have 5 to 10 properties that is giving us now enough cash, we can invest more flexibly 5, 10 years from now. That is giving us income that we don't have to work for because the properties are there, the tenants are there, the mortgage is more than a third of the way gone. And so it's now easier for us to make decisions that way. Whereas if I'm just trying to constantly build wealth through one medium, it limits our options, right? So I say all of that to really say persons should think investing is a long-term gain. It doesn't mean that you're holding only long-term, but you want to think past your current season and needs and see, maybe 15, 20, 30 years, the kind of lifestyle you want to have. And that should inform some of your decisions. That's how Warren Buffett is investing. And that's what made him those billions of dollars. He's thinking, far ahead. So
Yeah.
Yeah.
But
All right. So
I mean, very briefly, I mean, the investments will grow to a point where very quickly enough, relatively speaking, it doesn't even become a matter of lifestyle anymore. If done well
yeah,
and done materially. I think and I think it's very important that persons appreciate the journey they're on. I mean, okay, fine, people may say L.E.A.R.N buying NCB at $4 on a 10-year loan, right? Was rich already. Okay, fine. But when he had his issues in '09, illiquidity issues and insolvency issues and whatever, it's the same NCB which was growing, which brought him back on the Forbes list.
yeah,
So I said that, yeah, okay, fine. And we see the big yacht and everything, and that's as a result of NCB. I mean, I don't think there's
exactly.
any other investment of scope. I mean, so Kingston Wharves, I think 9 or whatever, he bought at $1, and now Kingston Wharves is 40 something, and whatever else. And there are other investments. He's still a large shareholder in RGR that I think is going to pay off massively for him. But he had to carry that for a long time. So as the persons focus on their vocation when you invest. Yes, you watch your portfolio every so often. You don't have to act on it every week, or every month. And if you do and it makes money, you're going to get to the point where you cannot do anything.
Yeah,
You just are going to have to sit down with it for long enough. But focus on their vocation, and in a sense, remember, the investment is not an supplementary income. That's what we call capital assets or capital expenditure. That's like I said, your investment needs to go to the point where you're not selling to pay a bill, a monthly bill. It don't make sense. I mean, okay, fine. I get to the point where you may use some to pay annual insurance, but you need to accelerate past that point very quickly, as quickly as the market allows, I should say, or as quickly as your earnings allow. Otherwise, it may mean that your expenses, you're living above your means.
Yep.
And that's also within the context of financial planning that we can also, explore at another time. But I mean, when I was starting out, years ago, all right, fine, look a short on a bill and sell your stock and you go do that because it was really all I had. I was like 21, like that's what you're going to do at 21. You're young, but into your 30s, you really have to take a stock away. No pun
Yeah.
intended. Say, you know what? I really need to do something meaningful. 'Cause the alternative is really living hand to mouth until you
Yeah.
retire and then you're hoping to inherit something. You know, I I have one parent alive, one passed, and my father educated me and my siblings, and I give thanks for that. But I have to make my own way, and I'm very grateful for the benefits that I would have had from his life. But lessons and everything, my father is good to me, and I have no issues there. But the whole point is that I can't live expecting anything from anybody.
Yeah.
So I have to make the most of the talents in my hand. Again, come back to the Bible. If I have two talents, I don't busy about my brethren who have 10 or the guy who have a half. I have two, or the good Lord come back and say, well, Father, we have 10 or 40, or
Yeah.
240. And that's really what the focus, I think, persons have to take a stock of their position and make some firm decisions that in 10 years I can look back and be like, well, I've seen forward movement. I have learned, I've invested, and I've grown. you know, and
I
that's
love
a,
that. I love that. I love that.
a big thing.
So we spoke about which investment strategy was overrated and underrated. You covered that for us. I'm going to ask you two other those types of questions.
Mhm,
Lump sum investing
mhm.
versus dollar cost averaging. I mean, both has its benefits, but in this case, I'm going to ask you to say which one can be more strategic for somebody at the starting point. And then since we've been saying, at a certain point, your portfolio decisions may change, which one might be more useful down the line?
Yeah. Well, I think either is fine until your portfolio explodes, meaning until you have a stock that grows 1,000%. I think what's important is just to get some skin in the game and money in the markets, right? But you see, again, short of an extraordinarily sized inflow, whether it may be insurance policy maturing or you do some side hustle that just brings in your annual salary in a matter of months. If your portfolio grows 1,000%, you may look on a lot. If your portfolio goes from 100,000 to 10 million, you will look at your $50,000 that you put down monthly and be like, Jono, do I really need to put this in the market now? Or should I save to do something else?
Yeah.
So it's all within the context of where it's. So if you're saying starting out as the people, it's always best to hold on. I guess do not disturb in right. We're good now. It's always best to start where you are with what you have. And I believe that consistency is important for the purpose of building habits because you get used to being able to part with money every month or however many periods, right?
Yeah.
What's important is, I think, is to leave the money in the markets. It grow and it blow up or whatever you decide you're going to stop invest for a while because you have enough NCB, you have enough grace, you have enough this, you have enough that. And you're going to steer your money towards furnishing your second house or your third house or this, that, or the other. You decide you're going to buy art or whatever. I mean, do what you have to do. Or you
Buy
have,
some NFTs.
NFTs, whatever on earth you want to do it. That's a lot different than, but then that person is so far along, and that person, more importantly, is one announcement away from seeing their net worth multiply because they
Yeah.
have sufficient skin and exposure in the game. So that's kind of where it is. I think, like for me, I don't like to make this about myself, but like I am actually now. Look at my whiteboard. I have some investing to do this year. I was actually investing up to the middle of last year and I stopped. I bought a couple assets and whatever, and I'm about to start again. The point, however, is that I'm still now waiting on the proverbial role to be called up yonder. But there's some stocks I hold that I really believe
Yeah.
are going to blow up in a big way at some point. I can't tell you when, but I know it's going to happen, and I'm adequately exposed, so I can live my life outside of that.
Yeah.
So you have to live too, right? The balance is that you can't just be investing to say, oh yeah, well in 10 years I'm going to enjoy myself. You don't know. We don't know what will happen tomorrow. So that whole balance of sufficient for the day is its own worry, sufficient for the day is its own expenditure, sufficient for the day is its own investing. So
Yeah.
that whole thing of balance in lifestyle and everything is, I think, is of value as well. So I mean, if one wants to pursue DCA and the lump sum, that's fine, but context. And you have to talk to an advisor about it and bounce
Yeah.
off of people. Because I said, no, all advisors aren't created equal.
Yeah. Agreed. All right. So the final one in this kind of segment here is diversification or concentration. I mean, you already kind of touched on it briefly, but just in case somebody missed it. So again, starting out investing, which one should I focus on as my portfolio grows, as my wealth grows? Which one should I focus on?
I think it comes down to the personality. So some people may prefer to diversify broadly, right? I am not so inclined. I think for me, three stocks is too little. I think 15 is too much locally. And that's also going to be a function of portfolio size as well. Because I don't know anybody with $1 million in three stocks either. Right? I don't know, and in a local context, I don't know anybody with the least I can think of is 5. Because your portfolio grows as well, people tend to become a little bit, more conservative, which explains why
That is
rich
true.
people buy bonds. And I said to people, they run themselves into problems when people who aren't rich try to act like rich people. When
Yeah.
rich guys are getting bond interest of 10 grand. You know what I mean? People think getting bond interest of $1,000 is money. And that's like, I'm like, you get there one day, but that's not for you. I'm saying you want to get your 10 grand to 150,000, then you can start thinking about one for 40.
Yeah.
But
Yeah.
steps. You don't know what that person who have $800,000 have to do to accumulate that. Not to say they did anything illicit, but you don't know if it's an inheritance. You don't know if it's somebody else's money that they're just rinsing until such time. You really don't know. So as if the person's building a portfolio, everything's context, nuance, and it's not one size fits all. So you have to stay in your own lane. Because the unfortunate thing about the world today is people don't want to. If you're going to scam somebody, you want to use the luster of lights, camera action to pull them in, which is why if you look at most scams, they use a lifestyle to draw you in because it's a distraction and it's a diversion from reality. So I say to persons, we're on this journey, stay in our own lane. NFTs, wonderful, crypto, wonderful, but the person who's put $100,000 in Bitcoin US, chances are has a $2 million US liquid portfolio. So they're not putting their last 100 grand in Bitcoin. Usually. Sure, if they bought it $1 and thing and it blew up to 50,000 or 40,000, wherever it is. No, that's different. But how many people did that?
Yeah. Yeah.
perspective.
Yeah. Fully agreed. So I like to say, I mean, there are different stages, right? If you're trying to build wealth, the strategy is different from when you're trying to maintain wealth. And I said this to a young man I was speaking to yesterday, as saying that there, at a certain point, when I mean when you're just starting out, you know, you want to get to that next step. When you get to that next step, you know, you've changed your house, you change your car, you change your phone, you buy certain things, you buy some clothes, you buy some watches. You start to look around and say, well, okay, I've done all of these things. What else can I do with my money?
Sure.
And so you started, as you said, usually after you build a certain amount of capital, you become a little bit more conservative. And that's because I guess you realize now that it took you X amount of years to build, and if you make the wrong decision, you can lose it much faster than you were able to build it. So you start to become a little bit more fearful, and so you're a little bit more hesitant to take a risk. But I mean, and I'm speaking that from personal experience, because when we got to a certain point, I realized that I was a lot more conservative than I was when we were just getting started. And, you know, I had to kind of work through those, you know, kind of concerns I have as a husband, as a father. You know, will I have enough? What if I can't work? You know, just as you say, we have to deal with life decisions. So
Yeah.
I mean, and you're right, nobody's going to take up all of their money to do an investment. If you start out small and it grows, that's a different thing. So I think persons should understand that the stage that you're at will determine your investment strategy.
Yeah.
So if it is that you have an opportunity to do a lump sum, do it. If it is that you are just, you know, you have $10,000 per month and you can dollar cost average, do that. But you know, your decisions will change based on income, priorities, dependence, health, all of those things. So
Yeah.
yeah.
I mean, like even in my case, so I mean, I still invest as aggressively, but I have, you know, I mean, I took out my first set of insurance policies with one of the investment houses, insurance houses in 2011, and 10 years later, you know, my income had another zero on it, I think. I don't remember, but whatever. And I've had to get more because the
Yeah.
truth is, I have no, I mean, I'm married now, I wasn't married then. I have different realities and a lot more persons depending on me now
There
and
you
more
go.
responsibilities. So, you know, you're buying a house, you have to have, you know, X insurance in case, even if you pay it off, you buy another one, you're still going to have, you know, so those are the realities that came before me. Now I have a greater appreciation for cash or the availability of cash and stuff. But, you know, even within that, you know, but this is for me, being that I'm still focused on stocks as my stock investing, whether liquid or illiquid, as part of my life, then you know, of course, it's still not hasn't left me. It's just it's a lot different from when I was just starting out, you know,
Yeah.
and
Yeah.
and that's the reality of it. And you just try and have more in different places, you know. But as I said, at the end of the day, you are who you are. You know, I am not. I am a stock guy. You know, I'm a business investor. You know, I call myself a businessman because I'm not an entrepreneur, and that I'm not going to start something. I more buy something
Yeah.
than start. You know, I think others are blessed with the skill to start. I perhaps I'm not. Well, I mean, you know, I'm not going to
Well,
start a factory tomorrow. I'll
I
buy a
mean,
factory, but I'm not starting one. You know, so
so each skill is equally important, you know, because the person with the skill to build needs a person with the skill to buy, to invest in that venture. So there is an opportunity in the market for every type of investor, depending, no matter where you are, no matter how much cash you have, your personal, you know, circumstances, you can get what you need out of the market. And that's what I love about investing. all of the different investors all can get their goals met from one place. So, you know, all right. So final segment of questions here. Then we get to the comments.
Sure.
What's your perspective on generational wealth, right? The Bible says a good man leaves an inheritance for his children's children, right? So that's a concept of generational wealth. What does that mean for you personally?
I think generational wealth starts with the current generation. I think we have a responsibility to ensure the next generation starts off on sound footing, better footing than what we had. I say that in the context, however, that the story of wealth told through the ages, and you see it in Jamaica. They said the first generation earns it, the second one maintains it, and the third one lick it out, right? So I don't think there's many stories of third generational wealth in Jamaica. The families that were prominent when I was growing up are not as prominent now. And that would have been going 30 years ago.
Yeah.
Generational wealth to me is really giving the generation that follows or the one after that one the option to I didn't even get that deep. I just want my kids to have a better life than I did. And the truth is, I had a pretty good life growing up in that respect. So, but for me as well, though, I don't think wealth has to just be physical because you can having too much cash in hand and not knowing how to earn a dollar can actually create
Do
more
more harm
problems
than good.
than
Yeah.
bad.
Yeah.
So for me, it's more what I want to convey to the generation, especially as a black man in a black family, is to ensure that it's not just for black people, but you'll understand where I'm going. Is effectively for my bloodline to appreciate what goes into wealth building, to appreciate the art of investing, to appreciate the art of business, and to appreciate, as simple as it sounds, how to earn a dollar. Many companies fold because they don't know how to earn a dollar. Effectively, they don't have a cash flow. And I mean, you can maneuver and use fancy finance terms, but at the end of the day, if you can't generate a dollar, which is why wholesales and the proprietors of them are rich in this Jamaica, because in many cases, because they know they get their stock, so they pay for their stock, or they borrow, get stock, sell it, have an excess, pay off the supplier, have a little bit, so they can get more stock, probably take less of a debt to get it. Eventually, they can pay for the stock out of cash, without any hiccups along the way. But they know what cash flow is. Inventory in, sales, collections, pay staff, boom, boom, have an excess, and the cycle continues. So my whole concern is just to ensure that generations after me, my bloodline and others, appreciate what that whole concept and notion is. So I believe that's what generational wealth is. Unfortunately, I think a lot of people speak about generational wealth and they don't have the first clue what it's about. I think when their kids a bag of things, and if you look at the pattern of rich wealthy, the children of wealthy persons, more often than not, how many of them do you buck up in business? Chances are none.
Yeah.
One, I mean, let's think about. I mean, you can go through the names. We know who is doing well and who is not. Because the truth is, it's a crapshoot. It's a luck of the draw thing more often than not. I think we as a current generation that's here, we need to do our best for the persons who are with us and who will come after us in terms of finances and assets and whatever. But more than that is the lessons. As I said, my father taught me the importance, whether directly or indirectly, of independence and how to generate on my own, in not in a way that conforms to the system. And that's really been the biggest takeaway. And the truth is, that's more than any dollar he could have left me. That's the priceless lesson. I
Yeah.
can't pay for that. And,
Yeah.
just now to convey that as it may apply.
Yeah. I mean, fully agreed with you there. For me, generational wealth is about preparing the next generation for building wealth based on what the future is likely to be. Meaning, as you said, there are some families where you may have wealth in this generation, but it doesn't translate. And I think sometimes that's because the way in which wealth is maybe built in the current generation, that business or that form of wealth now becomes obsolete, and the next generation is not prepared to transition that wealth into what it can, I guess, maintain or appreciate in its value. Hopefully that makes sense. But I mean, if 100 years ago you sold horses, you can't really sell horses now to build wealth. It would be something else that you're investing in, maybe the digital space or whatever. But there are principles of investing, principles of business, principles of wealth that once transferred, now they'll have the tools to be able to now manipulate what you've already laid a foundation for. So I'd definitely like your response there. So we're gonna close out these set of questions with three things that you think our audience should remember about investing to build wealth. Three takeaways that you'd want them to leave with.
Well, firstly, start. You can't get there if you don't start. You can't study your way to it. You just have to jump in the water. And the lesson is more valuable than the return on investment at the start, because as the amount you place grows, then you'll be a bit more knowledgeable with regard to the way forward. So one, I'd say to start. Second thing I'd say is to buy what you understand. That's pretty straightforward. And third, I'd say be patient where necessary. I the real money is made in the medium term. It's not made, yes, maybe made in a month. Yes, I agree. But if you can make it in a month, it's not going to grow 1,000% in a month. So then, if you sell it after 55% in a month, wonderful, right? But the question you have to ask is, if that thing grows 2,000% in 3 years and you have none, will you be happy with 3%? With 50%. I have three brothers, and I was talking to one of them, and I remember, and I tell a story every so often. We were talking about NCB, and the NCB was 75 at the time, and he was saying, "Boy, we place an order, and he want to get it at 74." I said to him, everything right. I said to him, "Do you want to haggle for $1 and watch this thing go to 140 and not have it? Or do you rather pay the dollar above your price and then hold it to 140?" I don't know what he did,
Yeah.
but I think that illustrates NCB. We sold at 200. We're looking to buy back now at 130 or whatever. I didn't see it falling, but we sold on, I think we would have sold 1,000,000 units for overall holdings at 200, primarily because there's a ratio we were not comfortable with, and we're buying at 40. So in the day, there wasn't really anything to lose, in that respect. The point, however, is that if we spend time, and we have bought for some at 70, and we actually bought for some at 200 before the ratio came, but we're comfortable holding. But the point is that, all that said, do you think he would have been comfortable holding out for $1? But even if he still held it now, he's up 90%. You
Yeah.
know, whether he bought it or not, I haven't asked. And truth be told, I don't want to know the answer. But I think that illustrates the third point as well.
I definitely learned that lesson as well. My wife actually revealed it to me that I was somewhat of a haggler, just in general, and I've learned to appreciate if something is valued, what you're being asked to pay for it, just pay for it, especially if it's an appreciating asset. Just spend the money. I mean, that marginal price of $1 or $2. I mean, we say this all the time with those stocks that are priced above a certain amount in our market, where persons are like, well, it's selling for 90 now, I want to buy it for 87.
Yeah.
Well, I mean, maybe you're trying to buy it for 87 because you're planning to sell at 95, when it could be, as you say, 150, 200, 300. Would you really care if you spend $3 more or $5 more? But it goes back to
Yes.
what we're saying before, Ryan, where a lot of persons are investing based on what others are saying or what others are doing. And what I find, at least with the persons I speak with, they don't really have the appetite for a certain type of investing, but that's what they're surrounded with. So they feel kind of compelled to say, well, I got it at 85 and I sold at 92, I'm good. But really and truly, if you ask them one on one, they may say, well, I didn't really need to sell, but I thought I should. You know what I mean? Like
Absolutely.
there's some simple things that I see with persons who I speak with, and being the founder of this community, I have the opportunity, I think, to speak to more investors. You probably, well, you definitely speak to a lot more than I do, but there are some simple decisions that we see that persons can make, that somebody asked me, for example, about a company that was down during the pandemic. We've been in the pandemic almost 2 years now. March will make 2 years.
Mhm.
And the person said, well, I bought it, it's down 20-30% from the pandemic, should I sell? And I say, how long were you planning to hold this company for? They said 3 to 5 years. I said, well, how long has it been? At the point it was a year. So I said, well, I'm not a financial advisor, but what would you say if you said your time horizon was 3 to 5 years? It's 12 months. Did you not expect any volatility at all? And you thought it was just going to be a straight line up for the
Right.
for the 3 to 5 years? So I mean, those are just some things that I think if persons understood about investing, they would just be a little bit more calm in terms of just letting the ebbs and flows of the market happen, and just take advantage of the opportunities that make sense, and just know that they can't catch every single opportunity because it's just maybe not practical for where they are.
Absolutely.
So, well,
Absolutely.
Ryan, I definitely want to thank you so much. We're going to the Q&A right now.
Sure.
If you're just joining us, it's definitely not too late. I spoke to Ryan about this before. So for those of you wondering, this is a long video. Why you have Ryan here so long? Ryan and I spoke about this. He's that's the kind of person Ryan is, very generous with his time. And um, we still have a record in Ryan from our first meeting. I don't know if you remember when.
I remember.
Yeah. All right. So we're officially entering the Q&A segment. So this is where you can ask your questions. Ryan will answer them to the best of his ability or willingness, I would say, because there may be some questions that you ask that he may not be able to comment on, and I'm sure he'll be quick to say that if it's a case. So Steph is asking for your advice on dealing with the fearful feeling of having your portfolio growing greatly, especially in a relatively short time. That's an interesting question.
Um, Something I'm trying to deal with myself. I mean, I think you have to remind yourself of, and the first, it comes down to which areas of the portfolio are growing. Were these stocks you bought for short term? You didn't see, you were speculating, or these stocks that you were buying to hold for the medium term because you see the business growing overseas and they've barely started to grow locally. Best example I can think of is RGR. I tell people every time I buy a stock, because somebody tell me I lose money, right? And my friend tell me to buy RGR, John Jackson, and at $2, I mean, John said me about RGR for about a year, and I was like, listen, man, it's not happening. And one day, during one of our talks, he said, listen, this is, and I said, okay, fine. I bought it 211, I bought it for myself, I bought it for others, and whatever. It went to 460, and I said, well, I didn't buy it for the growth. It's probably gonna fall. But the problem, again, I tell you, when you volume, you really can't trade. We're actually lucky to be able to get the amount we did, and much less to now go sell it and go try and buy back. So now it's 330 or wherever it is. I mean, nowhere near the price that I expected to be at, even when it was at 4 something. It just hasn't materialized yet because we haven't had enough earnings reports to show how far the business has left to go. The point I'm making is that I had a serious temptation to sell at 460. And then it became a thing of, well, I couldn't do it because, I'm participating in market for others. So I can't, I have to be very careful in terms of how I trade stocks I buy, right? Which is why I don't talk about stocks before I buy them, because I can't be said to be, obviously I'm in the market, so I have to guard against that. But the point I'm making is, even for stocks that I have not bought for others, if I think they're nowhere near their target, I have no issue. I just forget about it. That's honest to goodness truth. Nobody, I not looked at my portfolio in probably a month, and before that it was a month. And I think that's the best way, because you look at it and you see the money, you say, why? Can do a thing, I can do this or I can do that, and you get distracted, and you start to deviate from your overall plan. So for me, as other persons, the most important thing is to forget about it. As my other friend would say, he said to me, boy, people make a little money in the market. It's a very, very, very successful investor by him. Say, boy, people make a little money in the market and then skin catch a fire, and them can't do nothing but think about little money. And every minute them call, they want to ask you why the stock fall by 50 cents in a day, or why it go up by $1 in a day, because they're just obsessed about it. That's what happens in that middle passage, so to speak, where you ultimately you can completely fall off the investing wagon, because you're saying, boy, I can buy my house cash, or I can buy another yard cash, sell everything, and then in 3 years, if you had held, you could have sold 5%.
You could have buy 5 houses.
Exactly. So it's important to remember the end goal, because these are legitimate realities, and many people, there are people who sold L.E.A.R.N, they bought it $1, they went to 10, but then people are still drinking wine. I don't like to bring up wine in every interview, but it comes up a lot. But people are still drinking white rum, and Jamaica they still sell more white rum than Jamaicans in the country in a year. And the point is that it was bought at $700 the first time around. Second time around, it was still publicly traded. It was bought out to 430 and delisted. So the guy who sold at 10, should still be alive. He probably said, John, could have sold at 700. So it's, it's you have to keep words going in mind, because the investment is for capital stuff. It's not for your day-to-day expenses. I guess there are guys who do that, but your portfolio get big enough, you really can. It's not about that anymore.
Yeah, agreed. All right, Matthew is asking if you have any investment properties.
No.
Okay.
I have to think about that one, actually.
All right. We're getting, that a lot of persons commenting on the value of the conversation, saying, Strachan is saying it's a pleasure to hear you talk, and Chike is saying the same. Let me see. Well, Crypto Ken, you mentioned a stock. I'm not sure what stock. I don't know if you know the ticker. And HWAL was a big disappointment in 2021. I'm not sure which company. It seemed more like a comment than a question anyway. So let me just keep rolling. Yeah, I'm not sure which one that is. Akeem is asking, do you feel that a guarantee investor is a good tool to use for a form of compound interest? I'm not familiar with guarantee investor. I don't know if you know what it is, right?
Chances are it's not, but chances are it's not. I'll put it that way.
Yeah.
Yeah.
All
Anything
right.
has a guarantee,
Mm-hmm.
forget about it. It's not.
Yeah.
It's you're making money. You're paying the fund manager's salary.
Ah, okay. Okay.
I'm sorry, guys. That's the reality.
Yeah, man. Yeah, man. I got you. I got you. Troyan is saying as well, I presume you won't get your pension until 60, 65 and not guaranteed to live that long. Why not just invest in stocks? Oh, I think Troyan was answering somebody else's question. So
I mean,
never mind that.
I used to take that approach. I'll be honest. But you really want your stock investment to work in conjunction with the growth in your earnings. And as I said, for me, I just got to the point where I knew I was starting to become not reckless, but I knew that I could be a little more responsible. So to an extent, but I'll talk about it offline. If not, I don't really want to get too far into that detail. But
Yeah, man. Yeah, man. I
let's
got
just say
you.
for
I
me,
got you.
it was a necessary lifestyle choice.
Yeah, agreed. So so Christian is asking, how do you do your research and what do you look for during research on companies that you think will grow?
Good question. I look at the industry. I look at the patterns in the industry. So I try to understand the drivers of growth in the industry, and I try to look at as best as possible the multiples, the earnings multiples in the industry. So I don't use technical analysis at all. I'm strictly fundamental. That's my strength is in the fundamental side. If I need technical help, there's others I can ask. But I think that's more like predicting the future, and I'm not very good at that. So I really try to stick to my side of expertise. So I do a comparative analysis first and foremost, right? To kind of get an idea of the mean average. Then I look at everything else past that. Now, if it's an industry for argument's sake that requires less assets for revenue generation, then that's going to skew the ratios I look at. There's no point looking at, for argument's sake, assets to revenue in the case of the lab, for instance, that has no assets, right? So that's not going to inform so you can't compare the lab to a manufacturing company because one relies on fixed assets, the other one relies on intellectual capital, which
Yeah,
you cannot necessarily quantify as easily because yes, if you even think about it, they don't even put the HR on their balance sheet in terms of fixed assets. Because chances are people can get up and walk out tomorrow. So then it's a matter of, for like, if I was buying a lab, which, is a well-known story, the fact of the matter is I'm looking at staff, I'm looking at what measures that they put in to retain the staff, etc., 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 and other metrics. So if you're talking more in a more generic sense, though,
yeah,
I'm a revenue growth guy. I like to see revenue growth. I like I like manageable debt. I don't like heavy leverage, especially when I don't think the company can what's the word? Can see the revenue benefits in quick order. Sometimes companies just have dead weight debt on the balance sheet, and there's some, and they'll even report big profits, but the debt is going nowhere. And that's why you
yeah,
have to be very careful about the debt you incur, because you can incur dead weight debt that will never cause you to blow up because it's just there. It's like there are a company making half a $500 million profit, but they have $20 billion on it. They're not paying that off anytime soon. You know what I mean?
yeah,
If they make 500 million and 20 billion, then that's not an efficient business. So for me, those are a few of the metrics, but it's very nuanced. It's
yeah,
not. I can't do justice to it. No, I mean, I'll give you a good example. So Dolphin Cove, $6. I said to Andre, it's a true story. You can even ask him. Me and him in the office, I told him, run the numbers and tell me Normalize Dolphin Co's earnings pre-COVID. Give me a multiple. What's the share price? Dolphin Co was like $6 or $5. He said to me, boy, you look like $9. I said, all right, put him order, bought at 6. Dolphin Co is now 16, and
Yeah.
we sold a year before. I never got all the shares I want. I'm very upset about that. Nobody's fault but just the markets. But the point is, I could not say to you that. I think Dolphin Cove is probably the best run tourism business in the country. That's my view. Listed. Even better than CPJ. People differ. That's fine. They have their opinions. They make all the money. And they don't need to care about me. But I could not say to you I applied conventional analysis to come out at the conclusion that Andre and I came out at.
Yeah.
So it's very scientific and it differs.
Yeah, so I agree as well. So Christian, I'm not sure if you're aware, we have quite a few videos covering fundamental analysis on this channel. That's actually one of the ways in which I invest as well. So one of the things that I say all the time is that once you start to do the process of a couple of times, you will have these things that you look for that for you makes a company worth investing in. So it's not going to be the same thing for everybody because we have different preferences. So some persons want to see healthy cash flow, some persons want to see steady revenue growth, some persons want to see, good growth projection and less debt. Those are the things that you have to decide what means the most to you, and then match that with the companies that are known to perform well based on whatever criteria that you'd have. So, but we do have videos that covers that process in case you're not familiar with it, and just kind of determine what matters to you most in terms of what to look for, while understanding what other investors may be looking at to sort of know how to manage that. Well, Sachin was asking where can she learn to start stock investing. I think if you're here, then this is a good place to start. We have quite a number of videos to help you get started. So just check out the video section. There's a stock for beginners. We had a Learn Stocks for Beginners class in December. We're gonna actually be uploading that to a course platform that you can take, self-paced, get a certificate, all of that to be launched soon. So you can just stay tuned for that. Christian is asking you, Ryan, what are your thoughts on FESCO for this year?
Good question. Actually, I haven't looked at it closely enough to make a decision or a firm determination. The price has moved impressively though, but I am not an energy analyst, unfortunately, so I'm not able to, speak to that in great detail.
Okay. All right, thank you. Akeem is asking, do you feel that an index stock like MJE, QWI, Select, F&M will be a great investment tool for the Jamaican market? Similarly to how you might have the S&P 500 different index funds in the US.
I think that kind of ties up with the question. What was it? It was
diversification,
guaranteed investor thing. Usually,
okay.
You'll make money, but you're just paying the fund manager's salaries and hurdle fees and all of that. You don't think you're gonna. If the companies in it grow, then you benefit from the growth. So, good example, MJE to last check was 51% Supreme Ventures. Why not just buy Supreme Ventures? So it's kind of like that. Without having to pay all the management fees, whatever. If Supreme Ventures is to your liking, okay. If you don't like Supreme Ventures, then you really don't need to buy MJE. So everything just warrants a little deeper digging to know exactly what you're buying into. I said to people, for me, I prefer to take on my risk myself. So if I am going to take the risk of owning Lasco, I don't need you to buy Lasco for me. Me buy my own Lasco and forget about it. I don't need, you're not paying you to buy Lasco for it. That's me.
Yeah.
I
Yeah.
don't even want Lasco until Thy Kingdom come. All being equal. So, yeah, right. So that's kind of, I'm not saying it's not for everybody, but then what's the point of buying MJE, so to speak, not to pick on them, or buy QWI, and then you can buy every other stock that's in the portfolio. Like, you're doubling your exposure.
That, yeah. That's actually that point that you just made is one that I make for our community as well. Because we spoke about this early last year. Persons were asking about select F, and what I said is look at how select F is constructed. I mean, I would look at how those funds are weighted because it's not all equal. So if it's skewed towards one company, the 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 performance of the fund is going to be based on the companies that its heaviest weighting is in. Because even if there's a stock in it that does 1,000%, but they have 0.01% of it, you're not going to see great growth on that stock because of how it's weighted. So I mean, yeah, that's we've said that before here, definitely. Justine is asking which company is beginner friendly to a new investor. That's an interesting question.
Good question. Think about the products you use the most, Justine. If it's Grace Kennedy, if it's your bank, if you don't hate your bank, if it's Usinko, companies you understand really well at a very simple level, you know. Look in your fridge, like who makes the majority of the products in your fridge? Is it Jamaica Broilers? Is it not that it's just food, you buy a lot of spice for your chicken and use per tree. I think that's where the value comes up. I mean, if you go to the wharf a lot, you know, Kingston Wharves, if Meal Pack, there's so many others. The beauty is that there are many more options now than 10 years ago, thanks to the junior market and the amount of household companies that have started to come to marketing and on the main market as well. Do you have a Fontana a lot? Fontana is another option. So I think it all depends on the person. But bigger is usually better for beginners, put it that way. If you watch a lot of TV, you really can't go wrong with RJR if you watch local content.
Yep, I agree there. So Rashida is asking what is considered long term when you buy stocks?
Depends on the person, but for me, long term is, long term for me is 7 years plus.
Okay.
7 years plus. I'd say it's long term. Yeah.
Right. Ray, I think that's Jason Ray, is asking your thoughts on Spur Tree.
I don't know. You tell me. What do you think I think?
I was just saying, I'm gonna say that's not a serious question. So Karsten is asking, do you believe we've already seen the worst of COVID-19 and its impact on the local market?
Definitely. I think, unlike the US, the local market has not recovered fully, and I think that opens us up to rapid appreciation because, and I think if I know you guys have analysts in your ranks, it'd be helpful if somebody compared the movement of the economy and the movement of Jamaica Stock Exchange over the last 10 years and assess them and mirror them. And you could even use GDP growth. Perhaps it's even been GDP growth has been flat relative to the stock market, certainly up until 2020 Q1. But I think now we need to look at which one has recovered faster. Has it been GDP growth or the stock market? And I think that's a relatively good starting point, I would say, to examine, or to assess or to make predictions. I'll put it that way.
Yeah. And I'll also add to that, you know, what we've seen, and I think so the pandemic itself is a bad thing, right? What it has caused a lot of companies to do is make decisions that they would not have made were the conditions that the pandemic created were there, if that makes sense. So I think it has made a lot of companies more agile and decisive as it relates to debt and growth and how they're modeling their business, etc. So I think it has created a good atmosphere for some companies, definitely, and will position them so when we get to that point where things are more quote unquote normal, a lot of them are, I think, kind of tied up now and are going to be let loose when the further we get into this as things become more normal. So I think now is a great opportunity for a company that may not be doing much right now. And this is the trick, right? A lot of persons don't like to buy it and then they look the next day, the stock hasn't moved. Then they look the next week, the stock hasn't moved. Then they look the week after, it's down, 5%. Then 6 months from now, when you may hear that, okay, we're gonna have X amount, and now things open up, things back to normal, XYZ, the stock jumps 50, 100%. You're like, man, you know, like
Right,
those are the kind of things that I think persons need to just be mindful of, that the market will go as the environment and the businesses go, but you have to do a little bit of an assessment as to where you think it's headed, not where it is right now.
Yeah, absolutely. And I think many times pandemic presented great buying opportunities for the persons who may have felt they missed the proverbial boat,
There you go. Yeah.
you know, pre COVID, especially in the larger companies. Not Grace Kennedy, but there's still some bargains out there.
Yeah.
So,
Yeah.
I think it's a good opportunity to take advantage of that.
Yeah. Fully agreed. All right, we
Yeah.
have about 10 minutes to go. So I'm gonna just kind of scroll through some of these questions. There are some that I think we can maybe answer in the comments. So we'll kind of scan through. So Crypto Ken is asking, do you think that companies should continue to operate on the market when they're constantly failing to report earnings? It's an interesting question.
Which company?
Crypto Ken, you want to name any companies there? And we got that one already. Warren is asking, he says that he's a young investor locally, but if the day would come that he would want to enter the US market, how would he enter and what would qualify him?
My overview, this is for me to tell you now. I don't think persons really should venture into the US market until to do it properly, you want to be going in with 100,000 US dollars. Otherwise, the people making money in Jamaica and then you can look overseas. But the market is far too volatile. And this take it from somebody who invests millions for persons, that it is not like our local market. So you saw when encouragement fell 30% on the dividend on the royalty announcement.
Yep.
That has happened in the US market this year. Stocks that I can tell you about personally, last year, at least 3 times, and in 3 different holdings. So Jamaica market is great and you can make your money and thing. In terms of global context, it's still training wheels. When you go in that US market, it's a jungle. And you better know what you're doing, or else you will lose a lot of money very quickly.
Yeah.
You or your advisor. So I said the persons, until you have 100 grand to burn to like not care about for 7 years, I think you're better off making your money in Jamaica for the time being. And it's not an indictment on persons who may want to buy in with less, right? Doing buy one stock is fine, but the guy persons who got to as an expert in the US market, chances are to say, "Boy, I have a 20 grand and I want to do a thing." They may just say, "All right, buy these five and forget about it for 5 years."
Yeah.
Because that's really what's up. So I
Yeah.
think at the time there's persons out there who can guide appropriately. Maybe not many, but there's people.
Yeah. So you're saying essentially build capital first, build cash first before you go overseas, because there is money that can be made locally.
Yeah, definitely. And even said dance yard before you dance abroad.
All right. So Ricardo wants to understand your profit taking strategy. So he's asking if you take profits during a peak in a stock price, any at all. And he used the example of when Dolphin Cove hit the $9 that you were projecting. Did you take profits then?
No. But I sold NCB at 200.
Okay.
So
Okay.
it depends on. I think NCB is going way past 200. It's just that
Yeah.
that ratio at that particular moment, and still being in the trading business and having bought at 40 in many cases, it just made sense to give the investors a return that was tangible and that they could,
Yeah.
for those early stage ones. The ones who bought later, we're still holding, but it's very nuanced, and that's kind of where advisors earn their money literally. So that's a conversation that's so long that to explain it, it's just we'd sit
Yeah.
down there for like an hour going over it.
Yeah. All right. Steph is asking, what would you say is the cause of JMMB's price lagging behind its valuation?
Yeah, great question. I think um, JMMB is cross-listed, Steph, and the circumstance in Trinidad has seen there being the arbitrage play across the Jamaica Stock Exchange and Trinidad and Tobago Stock Exchange, where persons may sell JMB. There's selling pressure on JMB through the Jamaica Stock Exchange so that persons can effectively get US in Jamaica to go back to Trinidad where there is none. So that's why. And it's actually, I think, affecting Garden as well, and Grace Kennedy to a lesser extent.
Okay.
So that's more due to factors beyond JMB's control.
Yeah. Silver Gray is asking, what books do you recommend?
What books do I recommend? Hold on.
All right, let me give Ryan a sec there. All right, guys, please take a moment to like the video. We have 73 persons here, and I don't think we're having a good amount of likes based on who is here. Let me actually check. It really help us a lot for us to keep being able to provide good content if we're able to get more exposure. Really do appreciate if you like this video. Share the channel, subscribe if you haven't done so as yet. It would greatly help us. So we're just giving Ryan a sec. I'm going to try to scroll through some of the questions, see if I can answer the more general ones. All right. I'm not seeing any that I would like to answer, so I'm going to wait for Ryan. All right. Okay, cool. So let me tell you the last question that I'll take. The last question that I'll take is the one from Crypto Ken, logged at 8:52 p.m. Any other question that comes after that, I'll ask you to post it in the comments. I'll just send them to Ryan, and we can maybe do another live one day and answer them. All right. All right. All right, so let's just give Ryan a few more minutes. I think he's looking for the books based on the question that has been asked. Shout out to Finance with Lance. I think that's Lance already has a YouTube channel. Please do check it out. Lance, just comment below the video, share a link to your channel so persons can check it out. All right.
There's this book, which I have not read, but I recommend it because I just haven't had the time, to be honest with you. I have so many other things reading, but this is the Intelligent Investor, I think.
Nice.
But I bring it up. I'm telling you why I recommend it, because you have to identify your investment mentors. And so I am like, as best as possible, like I read every Berkshire Hathaway annual report and letter every year. So long reads, 20 odd pages. But so I'm a Buffett guy. So I'll always read what Buffett reads and listen to who he talks about. So he speaks about Benjamin Graham. I read about Benjamin Graham. Whatever Benjamin Graham speaks about, then I'll work with that. So I'm going to read this. So I read this and anything that Warren speaks about, and that's it. But
Cool.
that's for me.
Yeah.
Persons may not buy Warren Buffett and they like somebody else. So I say, well, they can read who they
Yeah.
like.
Yeah. I'll just say to the person who asked the question, it's important to kind of determine first, I guess, the type of investor you want to be. In Ryan's case, he's trying to model from Warren Buffett, so he will, focus on that type of content. But you may have a preference for a different type of investor, or a different investment strategy. You want to read along the line so you can become better at the strategy that you're trying to use. So bear that in mind. All right, we're going to try and go through the rest of these questions quickly, because I know you, Ryan, you wouldn't want to leave any questions on the table. So I want to get through as much as I can while, have us wrap up at a reasonable time. So A. Wilson is asking, can you explain how a managed portfolio works?
You pay somebody to manage your money, no? That's really it. There's nothing new under the sun. It's really that, whether it through a structure like a unit trust or a mutual fund or whatever, at the end of the day, it involves outside cash, securities, and a manager who gets paid fees. Whether that manager is 1 or 10 or 20 and the size of the portfolio, it don't matter, but that's really all it is. And it's overrated in terms of wealth creation. I don't know anybody who became a billionaire of unit trust.
I have no comment at all. Okay. So I think that answers the question. The follow-up one that I had. CryptoKen is asking, what are your thoughts on yield farming in crypto second layer? I don't know if you're a crypto investor at all, Ryan. I don't know if you.
Not really. We bought Coinbase and we sold at 312. We bought at 200 or whenever it crashed after IPO. That's the extent of my exposure. I think I may actually, thanks for that, actually need to buy back. I don't know what yield farming is, so forgive me. That's above my pay.
Yeah, man. Same here. I might have heard the term before, but I'm not sure. Maybe CryptoKen, if you want to explain it a little bit more, then we can maybe answer it. Philip is commenting on QWI being different. Philip, are you referring to what we were talking about earlier in terms of the funds, the index funds kind of thing? Is that what you're commenting on? Let us know.
It's different in that sense, yes, absolutely. I think QWI is different. So, but again, the whole principle is the same. Why would I buy QWI and Netflix, for argument's sake, which they may have held at one time? I'd rather. So if I'm buying it, I probably wouldn't buy the holdings in it.
Yeah.
So I have no issues there.
Yeah. Shout out to Philip, by the way. David Gray is asking, is Indus Pharma Limited a good stock to buy?
I can't answer that, David. I did the IPO.
Okay. All right. Akeem is asking, what's your take on Trans Jamaica for the future?
It's a great question, actually. The bond or the stock?
All right. Akeem, tell us which, the bond or the stock. Wagwan TV is asking, what broker do you recommend? I'm just gonna say, guys, Ryan works with GK Capital. It is a brokerage firm. You can open an account with them. So for as I say, actually a couple of broker questions. Someone was asking, is Mayberry or the other companies better? I'm like, speak to. I can send you a contact for somebody at GK Capital, and you can get an account open there, and you will not regret it.
I actually, funny story. So I know a lot of people have a lot of comments about Mayberry and all of that, but I need to say that I have, Mayberry is where this whole thing for me started, and I have nothing bad to say about Mayberry. I think Mayberry are pioneers in this stock brokerage business, and the first firm I believe that really took the art of stock brokerage to it's zenith in Jamaica, and definitely for that period, that I don't know, 12 year period. And
Yeah.
I think they birthed, I mean, most certainly, they would have birthed my career in the industry. So I think once you understand who you're dealing with in terms of a stockbroking firm, then, I think you really can't go wrong with a Mayberry, for instance. But I mean, all the other guys, everybody differs. Some sell unit trust, some don't. Mayberry doesn't. Grace Canadian Capital doesn't right now. So it really comes down to what one wants. If you want cutting edge investment advice, for argument's sake, there are firms that will tell you not to go to. I'm not going to name them here, but there are other, because that's not their focus. They want to get your funds to put you in a pool to buy unit trust or managed funds. Nothing wrong with that, right? There are others who will be able to give you that individual advice once you're at a certain dollar size, because it's a function of economics as well. But they'll also produce research papers for free.
Yeah.
So it really needs to be a discussion around what needs that individuals need. Remember now you also have J Trader. So like 10 years ago, you did a trade yourself more often than not. Unless, of course, again, you're at that pocket size that warrants somebody doing it for you. I mean, Mayberry doesn't do that. I'm a Mayberry client, and I didn't even know to use J Trader.
Yeah.
So I'm not day trading, so it don't really matter to me if I'm buying to hold, usually. So if I sell in a cent, a wild profit where I don't really care about 10 cents. So, comes on those horses for courses.
Yeah. All right. Diane, hopefully I'm pronouncing that correctly. How do you decide on what stock should be held long term versus short term?
Where the company is going, in my estimation. Yeah.
Short and simple answer. Rashida
Right.
is asking.
So let's expound briefly. Alcoa, we bought Alcoa $49 at the time. This probably about October last year, there was aluminum shortages the world over. You had the Jamaica fire. So we bought US market, we bought heavily for clients with a percentage. I think maybe 5% of the overall portfolio. I don't remember what number was. Alcoa 62 last week, we sold all of it. So we didn't expect the aluminum shortage to last forever, right? So we took advantage of it. Alcoa goes to an all-time high. We're out of the game. That's a good way to illustrate.
Yeah. All right. Rashida is saying that she bought equity in Wigton a few years ago when it listed, but its performance is very discouraging. Do you think this is one of those stocks that you just have to keep long term?
I have an answer, and I'm just trying to word it properly. I think you need to look at the stocks you buy in the context of the business. Wigton is a capital intensive company. If you read the prospectus, you would have seen where I think it's turbine 2, the second phase was due replacement in 2024, or 5 years after they listed. And so one could reasonably expect a loan or a capital raise of some sort to surface, because the turbines have a useful life of 20 years. That being said, one now then has to ask themselves, how much is their market going to expand at the time of the IPO? And what would the potential gain be? I think Wheaton went up to $1
Yeah,
and
I think
progressive.
$1.15 thereabout.
Right. One may ask, can they double their revenue overnight? Of course not. So any play on Wheaton is going to be a margin play. So you said to yourself, it's a margin play. Why would I hold through an IPO? You buy an IPO and thing and whatever, whatever. Why would you hold forever? Because it's going to be a dividend stock. Is that what one wants? I mean, if you're not putting in $20 million or something that's going to grow to $20 million, you're not going to be getting $1 million in dividends a year. And if that's the case, then I think I can think of other options for you. So all in all, I want to use Wigton to judge or to be encouraged or discouraged. But again, it's context. That kind of business, they can't upgrade their fleet or add more to their fleet in a week or a month. Like they can buy a machine, it come down and they commission it in 3 months. It doesn't work that way. So their means of generating revenue is not going to increase overnight. The turbine is not going to double their velocity overnight. So, that's all in all, I think to buy it expecting rapid growth at the time of the IPO is probably not the best decision.
Yeah.
I'll put it that way.
Okay. CryptoKen is asking, where are the opportunities to create investor funds to invest in real estate in Jamaica?
I mean,
I don't know how you
they're all
answer that
around. I don't know if that's something you have to pay me to tell you, man. I'm not that. Gonna cost us what to charge a fee for that.
All right. Don is asking, can Link be the cash app for the Caribbean?
Absolutely.
Okay.
No question.
All right. I think that is it. Dan is asking us when we're releasing our book. I mean, I don't even know what to answer that right now, but we are focused on creating courses. This year, we actually want to launch 4 courses, and we just want to really lay the foundation for this community and be able to answer some of the basic questions that you as investors have. We want to definitely help support more schools. The education sector is where we want to partner with early, because we want to give the next generation of investors the opportunity to know the basics that we didn't know when we started investing. That's our focus first. Truth being told, I have written the outline for 2 books. I've not started to write them yet, and that's because just the thought of writing a book is very intimidating. And I think for me, I just want to take my time and do it and not rush it. So it's going to be a ways off, I'll say. But it's definitely, something that we've written down, but we're focused on other things in the short term. All right. So last question is, what are your stock picks for 2022?
I don't normally do this, but I'm going to look at my whiteboard. I actually you know what? I'm giving this here. I like RJR. I like Lasco Manufacturing. I like Usinco, Fontana, NCB, Spurtree, JFP, whenever it lists, and Grace Kennedy. And maybe more.
Oh,
MDS.
we got a whole portfolio.
I'm sharing this year. I want to share more this year. So
Yeah.
I think we'll look back. I think the next earnings season in the middle of February will make a lot more evident, and
Yeah.
I think I think we'll tell a lot. Put it that way. I'm very optimistic.
Yeah. So all I'll add to that is that though we do our own stocks to watch here, though Ryan just shared those picks, you want to spend some time looking at those companies. I think sometimes persons wait to hear a pick that confirms one they already like, or they don't just want to jump into something. One of the things I always say is that you may know the pick, you don't know when the person who shares the pick is going to sell. So you may hear something that you like, but 2 years from now, Ryan may say, well, the company that he bought, he sold at X price, when you may still be holding it. You never know. So just bear that in mind when you take a pick of any kind from anywhere. Those are solid companies, though. We actually mentioned some of them in our stocks to watch video that we did last week. Be sure to check that out as well. And this new thing that we're doing, Ryan, I'll mention it here. We're going to be converting our videos to blog posts for our website. So you can look forward to some of the notes for those who might not have been able to catch the whole video. We'll try to do a summary of what we discussed to be posted in our newsletter, which if you look in our description, you'll see a link. Or if you're on Twitter, hit the subscribe button on our profile. You'll get an email every Monday with a summary of what we discussed the week before and what's coming up in the following week. So if you missed anything from what Ryan said here tonight, somebody's making notes. We're going to put all of it in a nice summary and send it out to you via email. Or if you prefer, rewatch the video as many times as you wish, make your notes, because that will help us as well in terms of watch time for the channel. So Ryan, I want to thank you. A lot. You're an extremely generous person. You're one of the first guests that we had on our channel, and I think a lot of the respect we have now from some of the persons who've been here is because of the value that you brought for the first few meetings that we had. So I really, really do appreciate it. So that I wish you all the best in terms of your business, clients, family, all of that.
Thank you.
And I mean, yes, and thank you for I think wearing the shirt was a very, very good touch, guys. There's a link in the description to buy the same T-shirt you see Ryan and I wearing. It's only $2,500. You can pick it up anytime. We have actually quite a number of shirts left. So if you want to purchase yours, you can just do that. For any question that we missed, sorry about that, post it in the comments below. Thank you everyone for being here. We're gonna leave likely this video up, but split it in some bite-sized content for those who want to maybe capture the specific points that we would have covered. Thank you guys so much. Please enjoy the rest of the evening. We'll see you Thursday with another video, and then we'll have our first stock review for the year next week. So be sure to vote in the poll that you see for the stock picks. The one that gets the most votes is the one that we're going to review. We're going to show you how to go through the full process of research to determine whether or not you should shortlist that company or not. So that's our process. So stay tuned for that. Silver Gray, I see your question. I'm going to ask you to post it in a comment, and I'll share it with Ryan, and we'll try to, as I said, cover the question at another time. Thank you guys so much. Thank you again, Ryan.
Take care. Thanks so much. All the best. Take care.